Welcome to this video on the speed to cash, a beginner's guide to understanding and measuring liquidity. We'll explore how quickly assets can be converted into usable cash and why this is a vital concept in finance. Liquidity measures how easily assets flow into cash. We can visualize this using states of matter. Liquid assets like cash are ready instantly. Slush assets, such as stocks, are easily melted into cash. Frozen assets, like real estate, take intense effort and time to convert. The $1,000 refrigerator test illustrates this. $1,000 in cash allows an instant transaction. However, $1,000 in rare books is illiquid. It requires steps like finding a buyer, haggling, and selling at a discount, forcing you to wait or sell at a steep discount. The liquidity spectrum ranges from highly liquid or fluid assets like cash and checking accounts to highly illiquid or friction assets such as real estate and rare collectibles. The cost of friction, like broker fees and time delays, eats into your cash value for illiquid assets. Liquidity exists in two arenas: market liquidity, which is the ease with which assets are bought and sold in the outside world, and accounting liquidity, which is the internal ability of an individual or company to pay off debts with the assets they hold. Market liquidity is influenced by trading volume. High-volume markets, like a stock exchange, have a strong magnetic pull that instantly closes the gap between buyer offers and seller expectations, known as the bid-ask spread. Low-volume markets, like rare collectibles, have a massive gap. Trading volume dictates the speed of a sale. High volume means millions of buyers and sellers, allowing instant sales without discounts. Comparing stocks, Intel's high trading volume makes it the most active and liquid, while Ford's lower volume makes it somewhat less liquid. Accounting liquidity focuses on internal finances and the ticking clock. It asks if you have enough accessible cash to pay immediate bills before time runs out. Current liabilities are financial obligations that must be paid within the next 12 months. Financial analysts use specific formulas, acting as filters, to stress test a company's financial health. The filters progressively restrict what counts as liquid assets. The golden rule is that when dividing assets by liabilities, you always want a result greater than 1.0. The liquidity ratio diagnostic table outlines three ratios. The current ratio is generous, including inventory. The quick ratio is moderate, excluding hard-to-sell inventory. The cash ratio is exacting, strictly assessing the ability to survive a worst-case emergency with pure cash. The illusion of safety highlights the critical connection between accounting and market liquidity. Your internal accounting liquidity is only as safe as the surrounding market. If the broader market freezes, those assets turn to ice, potentially sinking even a profitable company. The illiquidity trap carries hidden costs. When forced to sell an illiquid asset, you pay a steep friction tax. This results in sacrificing unrealized gains, heavy broker fees, desperation discounts, and ultimately, a severely reduced cash value. To manage your speed to cash, follow three rules. First, build a pure cash buffer in the most liquid assets. Second, check the volume of an asset before buying to avoid thinly traded assets. Third, know your personal current ratio, ensuring your liquid assets exceed current liabilities.